begin with the headlines. A 90-day truce in the US-China trade war. Tariffs down, equity markets up, dollar rallying, gold knocked back. All sounds rather tidy, doesn't it? But as ever, when something seems neatly resolved, it's usually because we've only been given the executive summary, not the footnotes, nor the disclaimers, and certainly not the underlying motives. So today, let's get into what's really going on beneath the polite phrasing of constructive dialogue and mutual respect. Earlier this week, the US and China agreed to a temporary rollback of the tariffs that had reached comically high levels, 145% on most Chinese imports, 125% on US goods going the other way. These levies have now been dialed back to 30% and 10% respectively. But the key word here is temporary. We're looking at a 90-day pause, not a resolution. The US also made it clear that it's holding on to a buffet of legacy tariffs, Section 301, Section 232, even tariffs tied to the fentanyl crisis. This wasn't a clean slate. This was a rearrangement of those pressure points. China's Ministry of Commerce called it a win for common sense, and the Global Times declared it a victory for China. Trump called it a total reset. Everyone got their headline, but nobody got a solution. The real takeaway, both sides were and still are bleeding. The US faced rising inflation, jittery markets, and growing political blowback. And China had up to 16 million jobs at risk, critical mineral exports on the line, and one skidding into uncomfortable territory. After months of economic playing chicken, they both blinked. But Washington seems keen to pretend that it didn't. And as with every geopolitical handshake that comes wrapped in patriotic self-congratulation, the real implications will unfold in the footnotes and not those headlines. Now let's entertain a heretical thought. What if chaos is the strategy? Enter the so-called Mar-a-Lago Accord. Yes, that idea floated by Stephen Mirren and channeled through Treasury Secretary Scott Bessent. It's a spiritual heir to the 1985 Plaza Accord and the 71 Smithsonian Agreement. Both of those were US efforts to force global monetary change through disruption. Now, this new vision, the Mar-a-Lago Accord, borrows heavily from history. In 1971, Nixon slapped a 10% tariff on imports and suspended gold convertibility. In 1985, Reagan's Treasury Secretary, then James Baker, corralled other G5 economies into weakening their currencies to boost US exports. And in both cases, the dollar was overvalued and the US presidents felt their hands were tied by foreign obstruction. Nixon famously adopted a madman persona, while Treasury Secretary John Connally told Europe, the dollar is our currency, but it's your problem. So is all of this starting to sound a bit familiar? Bessent and Mirror want to do it all again, but this time with less gold, more tariffs, and an even greater appetite for coercion. And so the objective is convince the world to accept a weaker dollar without jeopardizing its reserve status. But neither the Smithsonian nor the Plaza Accord lasted. The US fiscal spigot remained wide open, sucking in imports and pushing allies to abandon those fixed exchange rates. And the follow-up Louvre Accord tried to stabilize the system and triggered a market panic in 1987. Now, history threatens to repeat itself, but without the global goodwill that propped up America's prior maneuvers. And markets loved the truce. S&P up, NASDAQ up, dollar stronger. Gold fell nearly 3%, as it does when risk-on sentiment surges. But this is where the short game and the long game part company. Gold did not fall because it suddenly became less relevant. It fell because traders saw a temporary pause in the chaos and went back to chasing yield. It was a moment of relief, not resolution. Behind the scenes, the gold market tells a different story. In April, we saw one of the largest ever deliveries of physical gold from the futures market, over 6 million ounces, more than $21 billion in metal. Normally, futures contracts are closed out or cash settled, but this time, people wanted the gold, real physical gold in your hand stuff. Inventories are falling. Delivery demand is rising, and speculation is swirling that sovereign actors, possibly even the US Treasury itself, are preparing for something much larger. Monetary reset, revaluation, and frankly, it would explain this sudden appetite for physical. Remember, gold is many things, but most of all, it's that insurance against systemic failure. And right now, the system looks increasingly frayed. So let's be blunt. The US doesn't seem to have a coherent strategy, but it does have a method. Chaos, then deal. Escalate, then react. Demand, then backpedal. It's all very Trumpian, not in a partisan sense, but in a theatrical sense. The idea seems to be keep everyone guessing, keep the pressure high, and hope the other side folds first. But this approach has consequences. As Mohammed Al-Arian points out, the volatility in US tariff policy isn't just spooking markets, but it's undermining the entire economic narrative. Faith in the dollar, faith in the US as a stable counterparty, faith in globalization itself. And once that faith goes, what replaces it? Europe, for one, is no longer waiting to find out. Trump's tactics have triggered what many are calling the Trump boomerang effect. Far from cowering America's allies, his trade war posturing has galvanized Europe into action, fostering unity, boosting fiscal independence, and reviving integration. Germany is relaxing its constitutional debt brake to fund defense. France and Germany have rekindled their alliance, and for once, even Britain is edging back towards the EU, driven by cold strategic logic. If you can't rely on the US, find strength in numbers. And this is where gold comes back into view, not as a short-term hedge, but as that long-term escape hatch. Gold does not need a trade deal. It doesn't need that central bank, and it certainly doesn't need Scott Bessent and Healy Fink smiling for the cameras. Gold is just there. It's immune to political vanity, immune to monetary policy, and increasingly attractive in a world that's tired of being jerked around by weaponized currencies and whimsical tariffs. Physical gold demand is accelerating because the story is changing, not about inflation, but about system credibility, about trust. And we're not saying gold will jump every time Trump tweets or tariffs are tweaked, but we are saying that the reasons to own gold every time one of those things happen are becoming much harder to ignore and harder still to dismiss as that barbarous relic. So yes, the gold price dipped, but the real story here continues to emerge, that there is an awareness that the current system, the dollar, the tariffs, the debt-fueled diplomacy, that is starting to crack. The so-called truce with China, it's a bandage on a bullet wound. And the underlying rot, the deficits, deglobalization, monetary dysfunction, well, that continues to spread, which is why we say again, gold is not just a hedge against inflation. It's a hedge against policy failure, fiscal arrogance, and systemic delusion. The game plan may well be chaos, but your game plan doesn't have to be. Instead, head to that exit, but make sure you have your exit plan in place and get some gold.